Okay, good morning, everyone. I'd like to welcome you all to the Daily Energy Markets podcast. It's Wednesday, October the 8th. Delighted to be joined today by Alan Gelder, Laurie Haitayan, and soon, hopefully, Jose Shalhoub from Venezuela. Laurie, good morning. Let me go to you first. We just had a survey question that we had up yesterday, I think, to our audience, and the majority were saying that geopolitical tension and risk is going to be basically impacting oil supply most over the next year, with the demand and OPEC sort of a close half of that second. Would you agree? Are we seeing geopolitical risk sort of rear its head again as a disruptive potential force? We didn't really see any real disruption in the last year or two. And I also want an update from you on the Mideast tension situation with peace deal supposedly in the works.
So, good morning. To say that definitely, I guess the answers and like the geopolitical risks and disruptions basically are because President Trump had failed to bring peace in a couple of days after he came to power, because basically that was one of the messages, the clear messages that he made when he was elected, that or on his way to election, that I can end the Russia-Ukraine war. And we see today that, on the contrary, tensions are really high and drones are flying left, right, and center from Russia to the EU and from Ukraine to Russia, and even attacking the refineries and attacking ports that have to do directly with oil and byproducts. At the same time, we see that today there is a talk about an end to the Gaza war, but that doesn't mean that the Iran tension had eased or stopped. On the contrary, you see that Iran had stopped negotiations with the EU members that were like kind of mediators between Iran and the Americans. And today we don't see what is coming out of it. It's like, on the contrary, is a negative outlook than a positive outlook. And therefore, between Russia and Iran, these are like two good, main players in oil and gas. We see that there is tension around them, and there might be some supply disruption because of the ongoing political tension and the war, of course, between Russia and Ukraine. So that's what the market and analysts are reading today, saying that that's the main risk, because that's the biggest uncertainty. We don't know. For demand, basically, kind of, we know that demand is slow, but we're hoping that it will pick up by 2026 when the government, the US government opens up, and then with all these Fed decisions. So we'll see like all the flow of money and projects, and the economy will grow. And the same we see like with supply, again, oversupply, yes, maybe now, later, maybe, yes, the spare capacity is shrinking, but there is oil coming in. So on that, people feel more comfortable. They know kind of where we're heading, but they don't know where we're heading on the Russia-Ukraine. They don't know where we're heading on Iran-US tension. And then all this rapprochement that is happening, India, Russia, and China, all of that, definitely I would have voted for the geopolitical risks.
Okay, well, that explains why it's there. Thanks, Laurie. Alan Gelder from Wood Mackenzie, thanks again for joining us. Let's talk about one or two points that Laurie mentioned there. Let's start with the Russia, Ukraine, I suppose, supply disruption element, which is, and just kind of delve into Russian refineries. We've seen some drone attacks, of course, on those, some Russia saying itself diesel exports could be limited. What's that been doing to margins, and is that a new concern, do you think, for the market?
It's not a new concern. I mean, and to Laurie's point, it's something that's fundamentally uncertain, because we've had periods where Ukrainian drone attacks on Russia, there haven't been many. There's been little impact, in which case then it's been back to the traditional metrics of if it's a minor strike, a refinery is back within a week. If there's much more damage, it maybe takes about a month or so. But now we've got about 1.5 million barrels a day of Russian refining capacity that has been taken out by drone strikes, and that is basically supporting diesel price, because we're fundamentally getting less diesel out of the Russian refining system into the global market. It's complicated because of where it all goes, but we're suddenly getting less diesel, and that's supporting effectively diesel crack spreads in Europe, which is the key import center, and keeping refining margins high and providing some support to that whole market tightness that's going on. And these things are fundamentally unpredictable, because there's periods of quietness, and then we've seen over recent weeks an awful lot of activity that has been very, very successful. And it's a headline. You just wake up every morning, see what the news is. You just don't know, and that comes to that.
I mean, admittedly, the market is responding very efficiently these days because it has had these unpredictability for a while. But what about, Alan, just sticking with you on gasoline cracks? I mean, diesel's got some support, and that's maybe specifically also with the Russian refinery issue. Gasoline not faring so well, I mean, again, from a seasonal point of view as well. Where do you see that as we enter the fourth quarter?
So it's been stronger than we would have thought early in the summer, and that's because a key market uncertainty is what's happening to the Dangote refinery down in Nigeria, because if that's operating, there doesn't need to be much European gasoline going to West Africa, in which case you get the typical weakness in gasoline crack spreads. But they've been struggling to get their main gasoline upgrading unit running, going through turnarounds. It's something that everyone's watching very carefully. News is relatively sparse, but we're expecting that to return towards the end of the year because they're undertaking maintenance, and hopefully at some point they can run that unit reliably and stably, and then actually that will be a key source of gasoline supply into a key gasoline importing region, which basically will mean we'll be in a very distillate-led world, because a big source of gasoline imports is going to be satisfied by that machine. But it's had a troubled start to its life and its operations, and you get some interesting news. Disputes with the labour unions. Everybody's fired, everybody's not, and there's sort of teething problems on getting that unit stable and operating well.
Africa with so much potential, and yet still sort of producing the same old challenges, I suppose, on the social front, really, and management, to be fair, to those on the ground, but by the IOCs, which obviously has its own history there. Laurie, back to you. Give us an update. We haven't heard from you for a while on East Med gas. With all the tension happening in the East Med, if you consider that coastline. Has there been any dynamics of note in the last few months, both in the offshore Lebanon potential assets, the Cyprus? Of course, give us an update also on Egypt's intake of Israeli gas. Where are we at with that? You're on mute. We're still doing that.
Exactly. We will get to a place where one will start talking, like the microphone will open on its own.
Exactly.
I'm sure,
AI. Where's our AI buddy? AI buddy should be muting us.
Like AI can do so much.
Yeah.
Like, I'm impressed. I'm shocked it can't do this. Like, just open the mic for you.
Yeah.
So basically to say that, okay, if we want to start Lebanon is still waiting for some companies to be interested in its oil and gas sector and really coming with investment. And this is what we're not seeing yet. Well, the third licensing round is closing in November 2025, so in a couple of weeks. Okay. And we haven't heard from the ministry any signs that there might be companies that are interested. Still, Total Energy with ENI, Eni, and Qatar Energy are in Lebanon in one of the blocks, in Block 9, but we haven't seen any activities. So this is a missed opportunity, I think, but it depends. It has to do with Lebanon positioning itself in the region as an additional provider of energy for the region and for the needs of the region. On the other side, we see that Syria is attracting a lot of investment, but yet to see on offshore. We haven't heard any agreements on offshore. We're still seeing agreements that have to do with electricity, with renewables, and some sort of ramping up the oil the old fields, etc. But nothing again on offshore. And then Cyprus, definitely Cyprus is waiting for first gas to come after years and years, and this is 2027 most probably. But again, all projects that are going to come alive and come to a production, they're linked to the Egyptian market, and that says about the region that today Egypt is the one that can absorb the barrels that will come or the gas that is going to come to the market. Definitely the Israelis have been talking about the projects to expand the gas fields that they have to cater to the Egyptian market.
Yes.
At the same time, that was like for a couple of days was under fire and under political pressure because Prime Minister Netanyahu was saying that maybe we will stop that deal. And definitely, I think he backed from that kind of statement because that is a red flag for IOCs to hear that, okay, our expansion projects or our projects in general are going to be in that trapped in political tensions, and that is not good news for business, definitely. So he stopped using that against Egypt at the height of the crisis when they were trying to push Egypt to open borders to get more Gazans into Egypt. But they stopped doing that because this codependence that has been created between Egypt and Israel on gas is very important. Israel has gas, has capacities, can have more capacities, but they don't have enough market. So Egypt is the market.
And Egypt is a big market, desperate for gas.
And Egypt is desperate for gas. So this codependence is really interesting for us to look at with the heights of the crisis that was the Gaza crisis. So basically, that's the story for today from the East Med, and to be watched for what comes next.
Okay. Alan, we have a bulletin headline this morning. Again, let's switch back to the demand scenario. China building more oil storage sites over the next 2 years. Of course, just in the more immediate term, we've seen, Chinese storage supporting crude oil in the last few weeks, especially buying into that to fill that storage space. Some people saying we see that continuing into next year. I mean, from what you've heard on sentiment, should we be expecting that support that China has been lending, albeit less than usual, if you look at historical figures? Is the feeling that oil will still receive that support as we go into 2026?
Oh, I think that is a fantastic question, because we've got some wonderful satellite stuff, and we can monitor Chinese commercial crude stocks, and they kind of peaked in August of this year and then have been drifting downwards. So that market support in terms of inventory filling, which appeared very much Q2 and into Q3, has kind of stalled and might actually be weakening. But there is these new facilities being built, some of it around refinery expansions, and no doubt they will likely be filled. But if we look at our view of Chinese oil demand, actually we think next year might be their peak, actually, because gasoline demand is falling, diesel demand is falling, because diesel is not only construction's weak, but also there are new means of heavy goods vehicles, LNG, and also these electric replacement trucks. They're about a third. They're about a third of new vehicle sales already, so that's quite a dramatic change. Jet fuel we got growing. A lot of petrochemical projects are coming, but they're being delayed. So maybe we're in this probably plateau phase for Chinese oil demand, where we're not really expecting much dramatic change from.
I wanted to ask you about petchems, actually. Yeah, petchems. Why are you saying they might be delayed? What is the reasoning behind that? Is that because of exports of those products? Is that
margins are awful. It's simply I've just grossly simplified it. What we've had is a huge amount of capacity overbuild, particularly in China, over the last few years. Last year kind of paused a bit, and we're expecting that next wave to start. And we are fairly confident those plans will be delivered, but there's no need to rush. There's no need for speed, because petrochemical margins, Europe, North Asia, are very, very weak, and we're seeing, there's daily news of petrochemical facilities in Europe being under threat of closure because margins are weak, high cost, regulation, those typical burdens. So we're still expecting China to try and improve its self-sufficiency on its bulk commodity chems, this next wave, which will keep petrochemical margins suppressed. But that just means actually it's probably pragmatic for companies just to delay some of these projects, or not do them at the typical speed, be a little more efficient on resourcing. That we're seeing, which basically means the growth in petrochemical feedstock demand, we're expecting China is going to come a little bit more slowly.
Okay, Laurie, we have another headline on our bulletin about the EU planning to sanction providers of false flags to Russia's shadow fleet. We had a lot of talk about the shadow fleet last week at our Energy Markets Forum, and that it's just growing, basically regardless of initiatives by the EU or the US to impact Russian revenues, if you like. But that fleet is finding its way one way or another. And now we have this headline. I mean, what is this headline? Is it just the EU trying to show that it's trying to do something about it? Or do you think that could have an impact?
Look, first of all, EU doesn't want to see a disruption in energy, same as President Trump. But at the same time, they do have a problem that they need to pressure Russia to stop the war. So a kind of like the drone attacks that we are seeing that are very well targeted. So it's not like amateurish attacks. They know exactly what they're doing. At the same time, they know like what to target, when to target, so that there is no disruption for the global market, but at the same time to force Russia into maybe creating these gasoline shortages inside the country, so creating some sort of social tension that will distract Putin from the war, or even like for whatever reason they think that might cause like some sort of a pressure additionally to other pressures, which are like the sanction packages. So now the EU is going into October to discuss a 19th package, 19. Wow. So this is the 19th package for sanctioning Russia, and still the war is going on. And there are threats, and every day you hear about an airport in EU closing because of drones that are flying, and we don't know what these drones are. Maybe one day they will attack something, but now they're just flying in and out, so causing all this. So basically, what they're trying to do every time, trying to target some sections and then figuring out like, okay, so what's happening, how Russia and Russia's allies are reacting to these sanctions, and then going after another piece of it. So every time, but what we've heard, what we've learned during these years is like, yes, maybe the US, the EU, are developing some sorts of sanctions, but at the same time, on the other side, they're developing ways on bypassing sanctions, and they're becoming really professional in bypassing these sanctions. So this is a fight between putting sanctions and how to bypass sanctions. And this is what we're seeing. But flows are continuing because basically, initially, no one wants to see a disruption in flows because no one can handle high prices and disruption of energy, any sort of energy. We were talking about diesel, gasoline, gas oil. All of that is already putting pressure on the market in the EU, already with all the tensions on political tensions, France collapsing. You see like, even in Italy, where like you thought that it's a strong economy that is moving forward, you see like all these social tensions, demonstrations because of Gaza, wanting to take Meloni and her government to courts, etc. All of that are not good signs. So that and pushing pressure on diesel, gas oil, gasoline, all of that is not good sign as well. So
yeah, okay.
I mean, to be continued.
Yeah, to be continued. I mean, Alan, talking about pressure on prices, of course, we've had OPEC plus continuing to increase incrementally. That doesn't seem to be having too much of a dampening effect on crude oil. I mean, again, how worried should the products, how happy should they be maybe the products markets about the potential of OPEC plus action of increasing supply or not. I mean, we've got this kind of dichotomy at the moment of some people say, oh, we had a glut, and then suddenly we're now worried about supply because of extra capacity limitations from OPEC plus. How does the refined product market realistically look at the scenario? You know, are we in a glut or are we in a potential price spike scenario for crude? What would you say?
That very much right. That's what is driving some of the uncertainty. For the products market and the refiners, they typically prefer plenty of oil supply, plenty of Middle East barrels, because in a sense that fits their system better. And most refiners are designed around medium sour crudes, and by having more OPEC barrels on the market, you tend to get Dubai at a discount to Brent, and that makes the refiners that invested in their facilities get a higher margin from that. So they tend to prefer more OPEC supply than less. You've then got the dilemma, though. Typically, lower oil prices are associated with lower refining margins because the whole complex gets a little bit shorter. What they really, really want to avoid are shocks of supply loss, because you then get a rapid spike in crude price, and that typically crushes refining margins through the challenges of passing costs on. So in a sense, our view of the world is we see additional supply coming. Q4 this year is when that supply comes at a faster pace than demand growth, because demand's broadly flat. But it's not we're not expecting a single trigger event, because we're looking at it and there's just lots of little things creeping up. So it's more like a rising tide, and that rising tide will be masked, we think, until towards the end of the year, given how tight the diesel markets are going to be because of what's happened in Russia and the shortages we're seeing there. So we think product tightness is going to support crude until towards the end of the quarter, and then this oversupply becomes more apparent as we go into Q1. And that gives us a weaker outlook. That gives a weaker outlook for next year. That actually, we also got a weaker refining outlook for next year on the premise that actually some of the Russian capacity comes back, Dangote gets fixed, and then so for us, our commodity outlook 26 isn't going to be great.
GDP figures, perhaps the trade tensions maybe start to manifest on economies and consumer demand, etc. In the US, which hasn't really fed through yet.
Our economists are traditionalists, is how they describe themselves, and going, tariffs provide grit in the economy in terms of making trade more difficult, and ultimately tariffs are borne by the consumer, and the consumer has to pay. It's just taking a long time for that to kind of filter through. So our outlook for 26 isn't particularly positive.
Okay, but what is positive, as we see from that survey question, is gold, because that's been again on the up and up. It continues. It has had a fresh impetus the last 2-3 weeks, maybe fueled by the US shutdown, as well as all this, uncertainty and sort of demand for hedging increases. But what does this signal for oil markets is what we're asking in our survey today. Is it bullish? Is it bearish? Or no synergy at all? Does it push oil up to follow gold, as everyone's saying, oil has to go up with inflation. It has to follow all these other hard assets, but it isn't really doing that yet. Laurie, we'll see what we get on that response. Just sticking with supply and OPEC, one question, I mean, everyone's sort of now feeling like they're more predictable, OPEC, that we know what their strategy is now. They're incrementally increasing, they're continuing to, what they see is stabilize the market. What about the whole baseline question, that has been sort of shelved for now, but is really the question, isn't it, going forward for the group next year maybe? They have to sort that out, they're cleaning that up, supposedly that's why they're doing this. What's the latest on Libya, Iraq, those unknowns, if you like, within the group that have been, and of course UAE and for example countries like that which have been promised higher baselines.
Yeah, definitely. I think that's what's going to come next. As you said, like OPEC and OPEC Plus has been very good in so in clearing the way and being very certain in an uncertain world to keep at least like this pace of prices. Definitely they would want to see more high prices, but at least like you don't see these spikes and then the prices like really dramatically going up and down. That's what they don't want to see. But at the same time, yes, ambitions of countries, producing countries, definitely they do want to increase and they want to benefit, because as we all know, for the oil producers, they don't have much time with energy transition being a reality. Definitely, we see here and there analysis saying that President Trump's policies have an impact on accelerating or slowing down the energy transition, all of that, but it's something that is happening. And we're seeing systematic changes in how we provide electricity to people and in electric vehicles, all of that, and soon heavy transport, all of that, so that will have an impact. So these countries that definitely, like Libya and Iraq, these are like two cases where these are countries that rely on oil and gas. So these want to, they cannot not afford like sitting and waiting until whatever conditions are right for them to increase. They need to increase, they need to use that money, hoping that they will use the money to diversify their economies or to build a parallel economy to the oil economy. We don't see that happening. Libya, with all the political tensions in the country and the division. Iraq, with a lot of, like, we know the system in Iraq, and almost everyone works for the government. So then the government is only paying wages. We don't see investment that much, but they're trying. They do have their own development project that they want to link Iraq to Europe, all of that. They're trying. So all of that, if you have a development project that the way that Iraq has had created that vision, if you want, for Iraq, that needs money from the oil, that cannot be from other places, or else they will have to borrow at what price when they are really under pressure. So that's why these are like existential problems for them. It's not just about like, I want to increase 100,000 barrel or not. It is existential about the stability. So going forward, looking at the stability of the region, and most probably maybe about the prosperity of the region as well. Let's be optimistic this morning and say that, okay, the Gaza war has ended, hopefully. And then when you see Mr. Kushner going to Sharm el-Sheikh, that's a sign that there are some buildings that are going to happen. Hopefully that will benefit the Gazan people and the Palestinians, and not just a real estate that is unrealistic and detached from people, the people living in these areas. But let's say that reconstruction, it will be a huge reconstruction, same as we are seeing reconstruction in Syria, and then hopefully limited, it's not that big scale, but in Lebanon as well. So you have already 3 countries that are in need of reconstruction, and that would need money flowing, and activities flowing. So all of that is kind of linked, but definitely to say that definitely oil producers want to see an increase in their baseline, because the future is they're not comfortable in what comes in the future.
Of course. And I mean, you mentioned the transition. We don't have time for that now, but I would be good to get an update from you on again, the transition commitment in Europe as well, with everything else, as you said, the social, political problems, the defense concerns that where budgets are going, but perhaps for another time. There's our result. That's surprising. No synergy at all which is maybe a safe answer. We'll see where that survey goes later in the day, when everyone else in the communities had a chance to vote on it. I mean, Alan, what would you say is the correlation at the moment between gold, an asset like gold, and oil?
I went for no synergy because I've really struggled with the so I kind of thank you.
Well,
for
so far that's true, because we haven't seen oil pulled up.
We'll see at the end of the day because I'm struggling with this rising tide lifts all boats thesis because I kind of, and it could be heritage. I still feel oil is fundamentally a commodity, and that comes with its supply demand balance, which good old Omer on a Monday is vehemently against. So it's one of those things that 2026 will tell us which one it's tending more towards. But I think more of it as more of a commodity, and hence its linkage with gold and what's driving and all the things that are driving gold up far less linkage to oil is where
So you're a fundamentals man, not a liquidity man, not a liquidity cash man.
But that was a tough one. That was a tough one to decide. It was.
Well, I'm glad it's tough because we like to challenge everybody out there. But thank you so much, Alan and Laurie, for joining us. I'm sorry Jose didn't make it. He was ready to, but inshallah, he's okay. Next time we'll get an update. I had some good questions for him on Venezuela. Lots of fun and games happening there as well from the US administration. So we'll get, hopefully next time, we'll have him on and get an update there on the LATAM countries there. Thanks so much, everyone, for joining us. And have a great day.
Enjoy the rest of your day. Thanks, guys. Bye-bye.
Bye.